back. You're watching The Money Show on ET now. We just had an in-depth discussion on multi-asset funds, the purpose that they serve. Now, let's talk about one such multi-asset fund. It is the Axis Triple Advantage Fund. Quite an interesting name because it essentially explains what exactly the fund does. It gives you a triple advantage by putting money in all the three asset classes, equities, debt, as well as gold. And, it's the cynosure of all eyes, especially because of the kind of investment it has in gold and the rally that one has seen in gold prices. So let's introduce on the show Mr. R. Sivakumar, the head of fixed income for Axis Mutual Fund. He also manages, of course, the Axis Triple Advantage Fund. Mr. Sivakumar, many thanks for joining us today on ET now. Let's start off by talking about this Triple Advantage Fund. I think the name says it all, but why don't you start off by introducing this fund to our viewers? How does it invest across the three main asset classes?
All right. Thank you, first of all, for having me on the show, and it's great to be here. As you said, it does what it says on the tin. It's a fund which invests in these three asset classes: equities, fixed income, and gold. It is biased somewhat towards equities in the sense that typically we have about 65 to 70% of our money towards equities. That also gives us the advantage in terms of better tax treatment. And the remaining is invested in fixed income and gold. Approximately 20% goes into fixed income, and just under 15% would go in gold. The allocation between these three asset classes tends to be relatively static because we don't believe that we want to make large swings across these asset classes, and we would rather have the different correlations between these three assets play out in the fund.
So largely, you do have a big exposure to equities, almost 60% odd, and you usually try to keep it just where it is, not moving it around too much in terms of allocation. So let's start off with equities because obviously that's the biggest component. Equities is almost 67% odd, a little under 67%. So, Mr. Sivakumar, how do you pick and choose stocks, for the fund, and where the fund's money would go? What is the filtering process that you have in place? The criterion that you have in place, which a stock or a company must fulfill for it to enter your fund?
Right, that's a good question, and it's very important to discuss that. I think at Axis, we've over the last little over a decade now, we've been perfecting this art of managing equities under two very strong pillars. One is the quality focus. By quality, we mean quality of management, quality of financial performance, strong earnings trajectory, etc. And the second is growth. I think we are unabashedly a growth investor, and we believe that India is a long-term growth story. So if you marry these two ideas together, high quality growth companies is really what we are looking for. Obviously, you could have a situation where these high quality growth companies can become very expensive. So it's not that we don't ignore or we completely ignore valuations or prices, but the idea is the priority has to go towards financial performance, quality of earnings, and growth above everything else. And if a company fits that filter, it goes into our investment universe and it becomes available to the fund manager to pick and choose. And obviously there's an element of active management, which means that you want to rebalance your portfolio from time to time to take advantages of market movements.
Okay, all right. Now, of course, I think even though it's a very small portion of your portfolio, it's grabbing a lot of eyeballs for obvious reasons, and that's gold. I just want to understand, how is the gold bit of the portfolio performing? I think it's 10%, a little over 10% of the fund that is put in gold. The minimum is obviously 10%. With this rally in gold prices, are you not tempted to perhaps increase allocation over there, or you want to stick to that 60, 67, and the ratio that you currently have?
Yeah, I think one of the important things is that we don't take large active asset allocation calls. We want to be active managers on equities, we want to be active managers on debt, but on gold we are actually just investing in a gold ETF, and it's kind of like a fill it, shut it, forget it. We don't want to take large active calls. The reason for this are a couple. One is, as you rightly pointed out, over the last few months we have had a very large rally in gold, but if you go rewind back a few months or maybe the last few years, when gold was maybe not the star performer that it is today, the opposite question could very well have been asked, that why are you holding any gold at all? And I think what we have found over the period, over the last 10 years of this fund, since this fund was launched in 2010, is that the having a kind of passive allocation to gold and allowing gold to kind of be a foil to the other two asset classes is really what has worked for us. So we can't exactly time when will be the next opportunity for gold to perform, but having a certain allocation to gold at that point of time, I think really helps balance the long term, sort of reduce the volatility and balance the fund over the long period of time.
Okay, fair enough. And yes, you're absolutely right in that. We would have probably asked you this question when the equity bull run was as well there, that, why not 80% and why, 60%? So fair enough, I take your point. Who do you think this fund would be suitable for, Mr. Sivakumar? It's difficult to obviously have a benchmark, okay, for a large cap fund, you have, okay, the Nifty 100 or the Nifty 50. And if somebody says that, okay, I have a long-term time horizon, so maybe I'll invest in a mid-cap fund or a small-cap fund. So two questions there. What would be a benchmark for the fund? And secondly, who do you think this fund would be suitable for?
Right. I think very important question. The benchmark, obviously, the defined benchmark for the fund is 65% is the Nifty 50, 20% is Nifty composite bonds, and 15% is gold. So that's the defined benchmark. But that doesn't really tell you anything about what this fund is for or what this fund is about. I think the idea of the fund is to really balance out performance across all these three asset classes, because we have seen that these three asset classes work very differently across different parts of the cycle. So a few years ago it was all about the equity story. In the last few months it's been about the gold story, and of course bonds have had a fantastic run in the last couple of years as you have had this interest rate decline. So you have had different asset classes perform at different points of time, and this is one of those funds where we really encourage investors, don't take a view on any specific asset class when you're buying this fund. It's really about, I think, long-term savings. When you don't have a view on a specific asset class for the next 3 years, 5 years, 10 years or longer, how do you find a fund which really gives you exposure to all the asset classes? And I think that's the way we are looking at this portfolio. And I think investors also should look at it from this perspective. Please don't look at this fund as this is a fund which gives you the edge of gold. I don't think that's the right way to look at it. The way to look at it is that the gold will work or will kind of perform during these heightened uncertainty environments, like right now during the pandemic, or if you go back in 2012-13 when we had a currency sell-off, or indeed back in 2018 when we had a mini currency sell-off. These are periods of time when gold does really well because either currency is depreciating or globally there's a risk of. But it's not possible to time this. And I think having a neutral allocation or a passive allocation really helps in balancing out the portfolio. This works really well in a larger portfolio of an investor. I think when you're looking to build an asset allocation basket, of course, a 65, 20, 15 or any such allocation is not going to be perfect for every investor. But investors should look at this fund as a way to get a balanced allocation and then tack on other products, maybe another fixed income fund or a gold or an equity product, to achieve the exact asset allocation that the investor is looking for.
Okay, so this fund will perhaps not give you an edge because of gold, but it does perform well during these times that we are in the midst of right now, right? There's so much of heightened uncertainty. And yes, you raised very interesting points as well when you said about how it essentially, how perhaps if you don't have any view on a specific asset class, then this would be a good fund. How can investors essentially then understand their return expectations from the fund? Because Mr. Sivakumar, we understand from theoretically on paper, gold and equities tend to have an inverse relation. Like you mentioned, if things are uncertain, then equities does not do that well, but gold does well. So how should you sort of gauge what sort of return expectations one should have in this fund?
Yeah, I mean, I think it's very important to state the relationship. It's not that they have an inverse relationship. Most of the time, if you go back in time, you find that equities and gold are not well correlated at all, meaning they do their own things very separate from each other. But when you have very large negative moves on equities, drawdowns of 20% or more, which is typically called a bear market, in those environments we typically see gold do very well. And this is where typically when you have a large risk of event, events like what we are facing right now, or where we have seen recessions in the past, that's really when you've really seen gold come through. These are typically tend to be unexpected events, and therefore you can't really plan for it in advance, but that's really when the negative correlation shines through. You do see, of course, a slight negative correlation between equities and fixed income. So therefore, having bonds and equities in your portfolio already gives you a little bit of a balance. But I think gold, what it does is it gives you a little bit of protection when you have the most uncertainty. The upshot of all of this is that we can try and ride out the volatile phases in the market a lot smoother. And the maths in this are very compelling. I mean, if you have a 10% drawdown in your fund, it requires 11% to go back to previous NAV, previous high in NAV. If you have a 20% drawdown, you need a 25% go back. It is never linear, right? The decrease and the increase is never linear. If you have a 50% fall, you need a 100% rise. So it's never linear. So the idea of having a multi-asset portfolio is to ensure that you don't have very large drawdowns. And I think in that sense, this fund has really shown that it's able to impart a certain sense of balance and sort of reduce the volatility in a client's portfolio.
Okay, so makes sense. So if I have just summarize our conversation, Mr. Sivakumar, one last question from me. Axis has a large cap fund, a mid cap fund. Axis has, debt funds as well, medium duration funds, short term duration funds, and then Axis has a gold ETF as well, which is obviously doing very well. So would you have today, investors hold one unit of Axis large cap, one unit of Axis medium duration, one unit of Axis gold ETF, or one unit of Axis multi asset or triple advantage fund? Pardon me.
Yeah, I think it's a very, very good question. I think one very important thing to keep in mind is for many investors is that how do you rebalance your portfolio? See, when you have a very large runaway success in one part of your portfolio, let's say you actually had allocations in equities, bonds, and gold, and you had a very large runaway success in equities. At that point of time, would you trim back your equities or would you rather pile on to equities even more? The temptation is to add on to equities when it is doing really well or add on to gold when it is doing really well. In this fund, it actually works the other way. When one asset class really does well, its weight in the basket increases and we automatically start trimming it back because we want to bring it back to that, let's say 65% or thereabouts weight in equities. Or if gold rises above 15%, we will trim it back. The logic being that this fund constantly keeps taking profits from the asset class which is doing really well and plowing back into the asset class which is not doing well at that point of time. This is very difficult to do when it comes to balancing our own portfolio. Therefore, having your own asset allocation through different funds makes enormous sense to me. But I think a fund like this makes sense when it is when you find it difficult to do portfolio rebalancing on your own. Over time, we find that the rebalancing, the alpha that is added by the rebalancing, that is to say, to go from the outperforming fund to the or the outperforming asset class to the underperforming asset class itself adds significant alpha to the fund over a longer period of time.
Excellent. Mr. Sivakumar, really appreciate you sharing with us, your time, and also for which individuals is this multi-asset fund really for, and if your temperament is not the kind that, you would have the inclination to sort of sit and rebalance your portfolio as in when asset classes, change values, then this is perhaps the fund to pick for you. It helps reduce volatility as well. It gives the sort of balance as well to your, investment. So thank you so much, Mr. Sivakumar, for joining us. On that note, we will take a very short break. Don't go anywhere.